Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer and Portfolio Manager with Sanctuary Wealth, to discuss why the VIX is not trading higher than it is, and if that signals a potential time to buy in these names, very good quality names, where their valuations have been reset. I mean, Jeff, you would think we're under, what are we, 34.5 spot VIX? You would think with the down moves that we're seeing, I mean, steep losses, it would be a little bit higher than that.
Joe, it's a great point. If you think about the stark contrast, remember back in the pandemic, March of 2020, we saw the VIX go above 85. We go back to the Great Recession of 2008, we saw VIX in the 80s as well. So this is a great opportunity to really unpack what we are seeing. And it's the reaction we are seeing in equities. To your point, you're seeing a lot of valuations. Pick on technology, or even pick on some of the blue chip names. Look at a Boeing, look at a Lockheed Martin. Some of these names that are at deep discounts due to the significant selling pressure. But I want to really walk across the bridge and go back to my roots, Jill. Go back to the 10-year note. You know, I spent a lot of time in Chicago at the Board of Trade, trading in those pits, but I really think the bond leadership, or the velocity, the volatility specific to the 10-year note, that's really started the fire. And now here we are in a price discovery mode in the S&P 500, but I think it's all due to the 10-year note. If we just go back to January 1st, the 10-year note is at 1.53%. Overnight, Jill, we touched 3.20. It more than doubled. And that velocity is a ramification of a Fed misstep. No one really wants to say it, but the Federal Reserve made a big misstep when they called inflation being transitory. Now, all of a sudden, they're trying to move the needle too hawkish, too fast, and these are the ramifications, but it all goes back to the volatility specific to interest rates. Look at the corporate bond market, SPLD, down over 20%. We haven't seen that in a long time, Jill, but you're very smart to point out the fact that maybe this is an opportunity to see some type of step in, to buy some names that are on your list, because the VIX itself is not above 35.
Yeah, it really is interesting. I mean, look at mortgage rates as an example, nearly doubling in just a year. You wonder at some point, is the Fed thinking that, all right, we'll see such significant demand destruction that will put the housing market a little bit more even keeled and get the supply and demand back into more equilibrium? And other price, I mean, the prices at the pump, they're over $5. Where I live in New Jersey, it's not as extreme as the West Coast, but everything is expensive, whether it's flowers, produce, gasoline. At some point, people just aren't going to spend money.
Unequivocally. And here in Chicago, we are seeing inflation tangible. We're paying more for our food, certainly more for our gas. But to your point, when you talk about this dislocation is going to bring opportunity. But what did the Federal Reserve do? Well, I hate to pick on Fed Chairman Powell again, but nonetheless, they moved the money supply and they had to step in. They had to intervene when we saw the pandemic really shut down the global economy. They moved the money supply from January of 2020 from $15 trillion to November 2021, $21 trillion. That was a 25% increase. So now they're trying to reel it back in, but it's the velocity, Jill. They should have been not purchasing in Q4 of 2021. They just stopped buying assets in February. So I think they're trying to retract, backpedal, and even flip their hips and run the other way a little bit as this hawkish narrative hits the market. So I have a lot of focus on CPI this Wednesday. That's really going to help us measure. And this is really going to enable the Fed to stop being so hawkish, or maybe be less hawkish. If that CPI number comes in, if we see a plateau or a downtick inflation, now they have the opportunity to be a little bit more measured, but they're moving so fast because they're so far behind the 8 ball.
Yeah. And Jeff, to wrap up here, are there any names that look interesting? I mean, look at Micron, Nasdaq 100 heavyweight, right? Trading in single digit multiples. I mean, there are some deals out there we have to question, okay, it's trading below peer. They're growing revenue, they're growing earnings. There are some deals to be had out there.
There are, and certainly there's a ton of volatility. Looking at NVIDIA down 7% today. You're looking at some of these tech names that are still wildly volatile. But I go back to the boring names. Boring become back in vogue. So look at blue chip, tangible names. We talk about ExxonMobil. We talk about Chevron. Obviously, energy has been a leading sector this year. But we also talk about Lockheed Martin, CVS, Chubb, an insurance company, Duke Energy, Berkshire Hathaway. A lot of these names that we kind of forgot about in 2018, 19, and 20, those are blue chip tangible names. And that industrial kind of tilt, that defensive tilt, that has prevailed. That has actually provided outperformance. You know, I manage the portfolio, the Essential 40. And that Essential 40 portfolio, it's kind of a Peter Lynch 2.0, very boring, but become very sexy here in 2022.
Oh, yeah. Well, 100%, Jeff, too. I mean, many of those companies pay pretty healthy dividends, and
That's
everyone's
right.
looking for a source of income. And so you have that trade in there as well.
Well, it is. And look at EPD, enterprise products. You're looking at a dividend, and dividends, you have to be very careful in this type of market. Are you looking at value? Looking at dividends? Because you could have a 5 or 6% dividend and the actual stock itself is down 30, 40%. So be considerate when you're evaluating that. But I think if you understand owning names with large market caps, with strong balance sheets, they're going to prevail this volatility. And I think this really is a buying opportunity, but you have to be selective. You have to be considerate. For the first time in 2022, you really have to understand what's in your portfolio. And even if you're owning bonds, that's been the really downside here. Stocks and bonds have been getting beat up. So I think there's actually a ton of opportunity for all my bond geeks out there. Look at those longer term corporate bonds. They're at deep discounts. I think there's a huge opportunity in the corporate bond. It's a $5 trillion space, Jill. So I think you can really find a couple opportunities in those corporate high yielding bonds that have just been decimated.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.